I'm Ron Sneller, investment advisor representative, coming at you with your third quarter market outlook. I think it's important to preface this market outlook a little bit. The conventional wisdom from most of the Wall Street strategists coming into this year was that the economy would be going into recession and that stocks would keep falling in the first half of the year before starting to recover going into the second half of the year. However, in our first quarter market outlook, we outlined why we thought the opposite would actually happen, that the recession would be pushed out further than the market expected, setting the stage for the surprise rally in stocks in the first half of the year. We definitely got that surprise rally as the economy remained resilient with consistent positive economic surprises, falling inflation, and steady consumer spending. But it has been a bit of a trickier market as the rally has been dominated by the large cap tech related stocks, and half of the stocks in the S&P 500 actually returned less than 4%, and many of the stocks in the S&P 500 actually lost value. The return concentration was driven by the 7 largest stocks, each connected to the excitement around artificial intelligence or AI. And now these 7 stocks are back up to representing 27% of the entire S&P 500 index. The concentrated move in the market has left growth stocks trading well above their historical valuation ranges, while a singular focus on the AI-related trade has left many categories of stocks trading at or below their historical fair value ranges. More broadly, for years, our stance has been that stocks are cheap relative to interest rates, and it was a strong basis for our secularly bullish view on equities. That condition is now changed with the rapid increase in interest rates and this recent bounce back in stocks. Now, the earnings yield on stocks is about the same as it is on bonds. So, this is an important chart for asset allocation considerations. While the market has rallied on positive economic news in 2023 and some of the excitement around AI, we've not lost sight of the fact that there are 3 main indicators that argue for a recession, and they are still making that argument. First, interest rates. Interest rates have risen sharply, which usually follows and slows the economy and ultimately can rise to a level that can cause a recession. Secondly, the yield curve is still significantly inverted, which reflects the difference between short-term rates and long-term rates. That is negative, and basically it's a sign that's had a very, very good track record in predicting recessions. Third, leading economic indicators have weakened significantly, which also has a very good track record of predicting recessions. All of these conditions were present at the start of the year, and they have not been resolved. A big reason we thought the recession would be pushed out further than the consensus estimates was that employment was still strong and consumers still had excess savings from stimulus funds that were being spent down, but would not run out until the end of 2023 or early 2024, letting consumer spending remain strong and push out any recession further than what most pundits expected. Taking a step back to shape our view for the remainder of the year is a chart that we showed at the beginning of the year, which is a cycle composite for 2023. That's where you see the blue line. The actual market performance this year in orange has followed this path very closely and does probably give a pretty good expectation for the back half of the year. The cycle composite combines the 1-year, 4-year, and 10-year cycles for an expectation for the year. Now, it is just a guide, but it does objectively suggest that the market may have some type of pause in the rally, but ultimately can sustain these levels. This has been the third quarter market outlook. If you'd like to review your investments or your retirement plans to make sure that they are in alignment with your personal risk tolerance and your personal goals, please don't hesitate to reach out. I'm Ron Sneller, investment advisor representative. Thanks for tuning in.